the old monetary system was stable, and the new monetary system is an avalanche, and we've had enough snowflakes fall that the avalanche is broken free and it's got a ways to run. Consider the old monetary system is the Titanic. The lifeboat seats are represented by gold and silver and Bitcoin. The cost to you today, you want gold, it's $3,300. You want Bitcoin, it's $85,000. Same seat as the one I bought, but it's more expensive because we're a little further down the road. It may not go all the way to the Titanic sinking. I mean, we may just have really high inflation and a monetary reset.
Hello and welcome to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the JR Mining guy over on X, and of course your host of this channel. And I'm looking forward to bringing back Lawrence Lepard. You guys all know him. He's a sound money advocate, gold, silver, but also Bitcoin. And now he's an accomplished book author as well. He recently published about 8 weeks ago, The Big Print. It's about a monetary debasement and what the trends we've been seeing in the markets all along. And I'm really excited to catch up with him. We only spoke at the end of November last year, so of course a lot has happened. Pretty much everything's changed. So we'll start with a white piece of paper with him, and I'll let him draw the picture for us, and I'll guide him through that conversation. Before I switch over to my guest, though, please hit that like and subscribe button. Helps us out tremendously, reach a wider audience, and it helps us bring guests like Larry on the program on a regular basis. So really appreciate that, and it's free, by the way. So thank you so much for doing that. Now, Larry, it's great to have you back on the program. Congrats on publishing your book.
Yeah, thanks, Kai. It's really nice to be with you. I always enjoy our conversations, and boy, I'm glad that the book is published. So is my wife, because for about 6 months I was kind of a hermit, just head down writing the book, because I wanted to make sure I got it out before the big print occurred. The title of the book is The Big Print, and of course we've had two of those. We had one in 2008 and we had one in 2020, and there's a bigger one coming, and the book talks about that. But yeah, to go to your, let's reprise the macro since we talked last fall. I mean, well, first things first, I can't recall if Trump had won or not after we spoke, but before we spoke, but Trump winning was a huge deal. And then Trump got inaugurated in mid to late January, and another big deal. And then, of course, he's taken a lot of steps that are kind of changing the world monetary order, and they're very significant. There's room for debate over whether he's going about it in the right way, but at least he's trying to do something that puts us in the right direction. And we can all debate whether he's going too far, too fast, whatever. But in general, I think it's good that we do restructure the world monetary order. And, I guess we got to start, if you're going to say that's the case, what you start with is that we've got a bubble that's bursting. The stock market, AI-driven stuff, the Mag 7, in my view, and in the book I talk about it, has for quite some time been a bubble. And people have, but it's performed quite well. I mean, if you backward looking in the last 5 years, it's been a great place to have invested. And of course, people tend to look backwards in their investments and think that's good. I'm going to stay with it. And I think that's the wrong decision. I think we kind of reached the end of that road. And you can see that the market, the stock market has broken now with this recent announcement of tariffs. And then of course he's been on again, off again with tariffs. But to me, that punctured a sovereign debt bubble and an everything bubble, really. And so we're now in a new macro environment where we're playing by new rules. And I'm just finishing writing my quarterly report. One of the most interesting things is that gold and silver miners, are all up kind of in the 20 to 30% range. And the Mag 7 and the S&P was down slightly because it bounced near the end of the quarter, but even before April. But then in general, the stock market has been very soft, particularly the Mag 7. And then in April, it really got decked after the quarter ended. So it's a new set of rules, Kai, in a new environment. As you and I were talking about before the program began, it's been a long time coming. We've been waiting for this for so long. And there were many times I was just kind of wondering, will it ever come? But here we are.
Yeah, I've been saying as well, I've been questioning my own sanity, quite honestly, because we could all see the writing on the wall. We've been talking about this almost for like 3-4 years here on this channel, especially the last couple of years. It's gotten more urgent. Ever since, the Fed started hiking rates, I think we noticed that there's something completely off back in 2022, March 2022. That's when we really saw, the wheels fall off the wagon here in particular. And the tariffs were just the last drop in that bucket. I'm surprised how people are blaming the tariffs for overvaluations in the stock market.
Well, that's right. I mean, it always takes a trigger event, and I couldn't foresee that it was going to be the tariffs. But I knew that a market that was massively overvalued really only had one way to go, and that's down. And so, and interestingly, the sovereign debt thing just keeps on ticking away, getting worse and worse. The U.S. deficits have not really been solved. The DOGE program that Elon is trying to enact with the government, he even admitted the other day that, they're going to have a hard time saving $150 billion a year. And when we're running a deficit, the deficit run rate now is in the $2.2 trillion per year area. 150 doesn't move the needle that much. And so, because of that, what I think you're seeing, and everybody's seeing, I know I'm seeing, we talked about this as well, is just the relentless bid in gold. I mean, gold is up 55% in the last year. And, every morning I wake up and there's a new all-time high. And to me, what that tells you is the market is saying we are losing confidence in sovereign currencies. We're losing confidence in the ability of these governments to balance their budget. And since they're unbalanced, we believe that they're going to debase the currency to make payments. And that's what gold is saying loud and clear. Near the end of the year, Bitcoin said that as well, although that's backed off a little bit. It was at 106, and now it's back in the low 80s. But the point is, these two independent sound money alternatives to fiat currency are, very, very large alarm bells. And then we're starting to see a few other alarm bells, as we talked about. It's interesting, the dollar, which was 109, 110, at the end of the year, has slipped it below the 100 mark and probably has lower to go. So, in my view, what the markets are coming to realize is that these governments are trapped and that the only way out is to print money. And we now live in an inflationary environment. And the average investor, I think, made the mistake. The reason they rallied the stock market to new highs, post all the COVID print, was that they believed we were going to go back to the deflationary world that we lived in from the early 80s until 2000. And I think in 2000, when COVID came and they printed money and sent out stimmy checks, the trend changed, and we now live in an inflationary world. And until we solve that, it's not going to, we're going to have continuing bouts of inflation. And historically, inflation has been pretty bad for stocks. So, the stock market is really starting to get hit. And by and large, the analog, or the obverse of that, which is gold stocks tend to do well when the stock market's doing bad, and vice versa. Gold stocks have really started to rocket. We had a great first quarter, and this month is looking pretty good too. So,
this interview is brought to you by Yukon Metals. The company holds a highly prospective portfolio of gold, silver, copper, gold, and critical metals assets in the Yukon Territory. Led by a seasoned management team and board, the company leverages strong technical, financial, and territory expertise. With the support of core shareholders like Keith Neumeyer, who together with the Birdall family launched Snowline Gold, Yukon Metals is diving into their 2025 exploration program with strong discovery potential. The company has focused on 3 high-priority drill targets this season. Highlights include the Star River project, where they've uncovered bonanza-grade gold of over 100 grams per ton and silver of over 10 kilograms right at surface. The AC project hosts outcropping high-grade copper mineralization only 6 kilometers away from the Alaska Highway, while the Birch project hosts a 1.4-kilometer-long gold-in-soil anomaly, which the company interprets to be the surface expression of an intact copper porphyry. If you're looking to invest in a well-funded company backed by a strong shareholder base with district-scale potential, be sure to check out Yukon Metals, currently trading on the CSE under the ticker YMZ and the Frankfurt Stock Exchange under E770. To learn more, visit yukonmetals.com. We thank Yukon Metals for their support, and now let's jump back into the conversation. Yeah, gold stocks have outperformed gold 2-1 roughly. I think gold is up 22-23%. I haven't checked today. It's probably 23.5% now. So
yeah, they're up about 1.5 to 1. And by the way, they've got a long way to go. I mean, last year was a very unusual year. The metal outperformed the stocks. The GDX was up 9%. The metal was up closer to 19. So the stocks have really been beaten down. And the reason for that is everyone thought that the gold price move wasn't real. But I think what you're now starting to see is the belief. People are realizing, oh, this is real. And I got a chuckle the other day when I saw Goldman Sachs hit up their target to $4,500. And, these were all banks that 6 months ago were saying, oh, yeah, gold at 2,300, it's going back to 2,000. And now they're all kind of changing their tune, recognizing, I think, what I described earlier, which is the sovereign debt problem.
Yeah, let's elaborate on the sovereign debt problem. Maybe, define it just a little bit. What does it really mean? Sure. Is it just money that was parked in the U.S. or invested in the U.S. being, leaving the U.S.? Or is it just everybody's debt situation is too high?
There's all of that, too. I mean, with some of the stuff that Trump is doing with the tariffs, we're seeing foreign selling. And if you think about it, if a foreigner loses money, if a foreigner owns a U.S. stock and that stock goes down 10%, well, that's painful. They lose 10%. But if in turn, if the dollar goes down 10%, well, then they go to convert their dollars back to their home currency, and so now they've lost 20%. So yes, we're seeing foreign money coming out of the U.S. stock market. And I think that trend has quite a ways to run. But more importantly, just to answer your question about, let's define the sovereign debt bubble. So, this is what I call a death cycle or a death doom loop, and it's pretty straightforward. The U.S. federal government has $37 trillion in debt, and my book lays this out and shows you how rapidly that's grown. And then, as Powell pushed interest rates up to try and deal with the COVID inflation, interest expense has grown as well. So now the U.S. federal government spends close to $1.2 trillion a year on interest, just on the existing debt. And that's larger than the defense budget. That's a big number. And in turn, the U.S. government is running deficits, which they ran during COVID. You could explain that, as a crisis. But they kept running them post-COVID. You would have thought the spending would go down. It didn't. And so, last year's deficit was 1.8 trillion. This one's running to something over 2. And here's what happens. To cover that deficit, they have to sell bonds. They sell bonds into a bond market of a fixed size. If you come to sell more, if there's more supply of bonds and the same number of buyers, then the price of the bond, the interest rate on the bond has to go up to entice people to buy them. That interest rate going up is what the federal government then has to pay on all the existing bonds as they roll over. That then makes the 1.2 trillion of interest expense become a bigger number in the following year. That then makes the deficit become a bigger number. That then means they got to sell more bonds. And you see where I'm going here? You've got kind of a negative feedback loop that really is at the core of the problem. And in fact, it was the U.S. 10-year moving from, when they first announced the tariffs, the stock market went down and the bond market did what it traditionally did. It was a safe haven and it rallied. And that looked good. That was kind of what the Senate probably wanted. But that rally didn't last very long, and pretty soon people started selling the bonds too. And I think the reason for that is people realize that the stock market going down will decrease tax revenues, will increase social payments, and the deficits will get ever larger. And so this is a problem that it's hard. It's Lynn Alden's meme. Nothing stops this train. It's very hard to reverse this cycle that we're in, and that's what's really leading to the sovereign debt crisis. And so, where it ends, we don't know. We can map out a lot of possibilities. The book does that. I give you a lot of scenarios, but it certainly doesn't end in less inflation. I'll say that with a high level of confidence. So.
Yeah, even Powell's been warning about higher inflation caused by the tariffs in general and slower economic growth. So without saying, but he was talking about stagflation. Okay, I'm not sure why he wouldn't put a label on it, the proper label on it as well. What do you make of that? We're exactly 3 weeks away from the next Fed announcement. Well, what do you make of it?
That poor bastard, he's really trapped. I mean, he really is. I mean, he should have resigned a long time ago. I wouldn't want his job.
For $180,000 a year, you got all the headache, right?
Yeah, right. Well, he's got $100 million plus net worth, so like I say, he doesn't need it. But as we know, ego drives people to do these things. But anyway, I don't know honestly. I mean, they know they're running out of runway in terms of the ability of the monetary system to handle the debt, and I'll give you a couple of data points on that. First is they. At the last Fed meeting, they took the quantitative tightening, which is shrinking their balance sheet, reducing the money supply, or at least reducing reserves, which have the effect of reducing the money supply. They took that from 25 a month to 5. I thought that was interesting. They more recently have been talking about, some of the Fed governors were saying, well, we stand ready. When they saw the bond market back up from the low 3.38 to 4.4, so they very quickly went to Trump and said, sir, you got to put a 90-day wait on these tariffs. The bond market's falling apart. And so he did, and that got everybody calmed down. You also see, other little inklings of money printing coming. There's something James Lavish did a really nice job in his Informationist newsletter of laying out how the hedge funds are one of the largest buyers of the treasuries, and they do that because they do a basis trade, which is to say they sell a future treasury and buy a current one, and they can make a spread between the two as time goes by. And they lever that trade up very, very highly to give themselves a large profit if and when it works. The problem is that those spreads disappear or become disorderly in a very chaotic market, and the hedge funds can effectively find themselves quickly bankrupt unless they have access to new money. And so a Brookings Institute paper came out and said, we think that the Fed should give these hedge funds preemptive swap lines, which means preemptively we're going to print money to save these hedge funds. Kind of what they did with in 2020 and the COVID crisis, and also in 2008 when they bailed the banks out. And so, again, Kai, the book talks about this. I mean, the Fed really, at the end of the day, I mean, they have a lot of jawboning things they can do, but at the end of the day, the one big hammer they have is the money printer. And if there's not enough money in the system, the debt keeps growing. They got to service the debt. Well, what do? You print more money to do it. And so that's what I see forthcoming, and that's why I named the book The Big Print. And I believe that big print we're on the cusp of it. I don't know if it's in 2 days, 2 weeks, 2 months, but it's not 2 years. It's got to happen probably in the next 6 months.
Yeah, no, I tend to agree. I think the pace is massively or drastically accelerating here.
Yeah,
we're seeing.
These market moves. I mean, when you have market moves like this, I mean, typically somebody's in trouble, somebody's blowing up, and we don't know who it is yet, but it will probably surface sometime in the next month or two.
Yeah, exactly. It's not the billionaires being invited to the Oval Office and showing, like, this gentleman made $800 million yesterday. This one made $1 billion yesterday.
Yeah.
That was a bit ridiculous, by the way, but that's a different story.
Yeah.
Do you see the Fed actually raise rates this year, Larry?
I don't. I suppose they could. I mean, one of the things, Jeff Gundlach is a very smart bond guy, and by the way, he recommends you only have all your bonds short duration, 5 years or less. But he's floated an idea that I thought was kind of interesting and creative. Typically, historically, what the Fed has done is they cut interest rates to zero, and then if that's not enough, they do QE. They buy bonds. He said that maybe this time around they'll try a slightly different playbook, which is to say they'll leave interest rates high. The notion there that they're trying to slow the economy down and deal with inflation, but they'll support the bond market. They will do QE. They will buy bonds. They will increase bank reserves and so forth in order to grow the money supply. And I think I forgot to add on that Brookings Institute paper, that SLR thing they're talking about. I mean, if they eliminate that SLR, which is a supplementary leverage ratio for the banks, that means the banks will be able to kind of conduct QE to infinity. So, the Fed, I mean, one of the things that we're going to see here, Kai, I think, is the Fed is going to create all kinds of very creative ways of printing money without saying they're printing money. And they kind of did this with Silicon Valley Bank, right? Silicon Valley Bank failed, and in theory, Dodd-Frank says they should have put it out of business and made the depositors take a hit, but they didn't. They used the systematic risk exception and they bailed it out. But they didn't say they bailed it out. They claimed they didn't, and they said the BTFP was just a loan, blah, blah, blah. I mean, I think that's similar to what's going to happen here. They're going to try and figure out some way to get more money into the system to prevent the system from collapsing. They'll have a new name for it, a new policy objective. But at the end of the day, what it'll really add up to is they'll be printing money. So.
Yeah, no, curious. You touched on the QT part and the softening stance on QT, meaning going from $25 billion a month, which was already fairly low, to now $5 billion, which is pretty much zero. Let's be honest.
Right,
they could have said zero, but that would have made people very nervous. I think the $5 billion is just an arbitrary number, not to ruffle any feathers here. What does that do? That QT part, or the easing of QT?
It just leaves more money in the system, and to add to that, they're also having the MBS. They didn't touch the mortgage-backed securities. They're still letting the mortgage-backed securities run off. And what happens is a bond runs off, and it gets paid off, and so the money supply shrinks as that money comes back to the Fed. They did say they might keep the balance sheet flat, which would imply that they were going to let that proceeds from the MBS then be used to buy more Treasury bonds. So in effect, that's kind of a backdoor form of QE if they stay flat, which is to say they let the MBS run off, and I think they're doing that to try and cool the housing market, but they use the proceeds to buy the Treasury bonds. And look, I mean, and it was interesting to me, if you watched the Powell press conference, he said, "Oh, this is really nothing. It's really not important." Well, bullshit. I mean, you were shrinking your balance sheet, trying to tighten the money supply, and you've decided to change that policy, dude. That is something. Like I say, they're really caught in a very, very tricky position, Kai. And the notion of raising rates, I don't think they can do that. My sense is what will happen is I think we haven't talked about the economy. You see overseas bookings into the United States. You see a lot of indications. I mean, these tariffs are very chaotic, and my sense is a lot of businesses, a lot of individuals, and you see, the stock market's down, round numbers. It was down 20%, bounced a little bit. There's a big wealth effect in the United States. I mean, the top 10% own most of the stocks. The top 10% also account for 50% of the spending. when somebody sees their retirement account take a 20% haircut at the margin, they think to themselves, well, don't need that new car, don't need that vacation, don't need that second house, whatever it might be. So, and that filters through the entire economy. And so I believe we're going into an economic downturn. We've juiced the economy for so many years, for so long, that we're going into an economic downturn. And that's going to have all kinds of subsidiary effects. I mean, one is that, tax receipts will go down and social spending will go up. I mean, in 2000 and 2008, when we had those downturns, the deficit went up, to 6 and 9% of GDP, respectively. So, it's one hell of a mess. And I think what they're going to be forced into doing is what I call yield curve control, which is to say, and what I keep a close eye on, I keep a very close eye on the price of gold, the price of Bitcoin, silver, all that stuff, and the stock market. The other thing I keep a very close eye on is the 10-year and the 30-year U.S. Treasury and the Japanese bonds as well. And you can see that the interest rates are in both those areas all those areas are marching up. And I think the 5% is kind of the pain point on the U.S. 10-year. I think if the U.S. 10-year gets to 5%, the Fed's going to say, no mas, we can't have it higher than that. We'll put in some facility we're going to buy 10 years. And how are you going to do that? Well, a mouse click of money, and they're going to put them on their balance sheet, and they're going to put those reserves into the banking system, and the banks can lend against them. And so, that's to me what is a likely next step. It's kind of an industrial financial policy. And a lot of people have actually been talking about that's necessary. I mean, China kind of has industrial national policy, and I'm beginning to think maybe they're trying to, do the same thing. They're going to have to do the same thing here in the U.S. I thought it interesting. Besant said he has breakfast once a week with Jay Powell, and my sense is Powell's pretty good at spinning anything the way he wants. I mean, so unemployment will start to get higher. The stock market will be down 25 or 30%. Maybe we'll get a couple of other good inflation prints. I mean, they can usually doctor those a little bit. And then they're going to say, hey, guys, we're really worried about our employment mandate. Inflation's going in the right direction. It's all going to be okay. We need to start cutting rates aggressively, and we need to institute this quantitative easing policy again. And, as if gold and silver and Bitcoin hadn't done well already, at that point in time, everybody's going to go, oh, my God, they can never stop printing, can they? I mean, I think a lot of people believed in bonds and believed in stocks because they thought, well, Powell is Volcker and he'll get it all under control. We'll go back to this deflationary trend. COVID was just a nasty blip, and everything will be okay again. And I think that if they're forced into this next pivot, which I think they will be, the psychology will change to, oh my God, they really can't stop, can they? And that's when, if you study high rates of inflation and superinflationary events historically, that's when they occur. They occur when everybody comes to the same conclusion. They cannot stop printing money in the system the way the system is now constructed. And that's what my book really lays out in great detail and tries to show people that is true, and that based on that truth, the way to protect oneself in terms of investing in assets is to own things that the government can't print. The government can't print gold, and the government can't print silver, and the government can't print Bitcoin. And so I think those will be three of the best performing assets in the next 5 or 10 years.
We'll get to those. Like I wanted to speak to a sound money advocate here, but I'm curious what the role of oil is in all of this, and I'm looking at it because it's a proclaimed goal of the Trump administration to get the oil price lower. Is that, lower oil prices are per se deflationary? Because it flows into a lot of things. Like How much of a counterbalance can a lower oil price be to the whole discussion that you just mentioned? Yeah,
there's no doubt it will help. And one of the great things Trump is doing is trying to break through all these regulations, kind of deregulate everything, drill baby drill, Besant's 3-3-3 plan. I mean, look, getting the price of oil lower will be a great deflationary tailwind. It would definitely help us. There is no doubt about that, and I hope they do it. But my sense is that alone is not enough. The oil market's big, the oil market's important, and I think oil prices probably will fall. I mean, you've seen there's a great schedule on Twitter that showed European bookings of Europeans traveling to the United States have literally fallen off a cliff because they're all so angry at what Trump's doing. And so, people travel less, we're going to use less oil. And so, it's a positive thing. It's a very positive thing, lower oil prices. But that alone is not going to solve us. This is bigger than oil, in my opinion.
Yeah, I don't think we want the US or TSA look at our spicy photos on our cell phones. That's why we're not coming.
Is that it?
No, but I'm looking at the exchange rate because I got a couple trips planned to the US, and I'm getting more excited by the minute. The euro is all of a sudden getting me $1.14. So keep it up. I'm all for it.
I used to like to go over there because I thought, I was in Paris last year. I thought, boy, this stuff is cheap. It's pretty nice over here.
No, exactly. So I'm looking at it from that angle. Maybe just to stay on the oil price topic as well. Back in the day, you used to call it QE for the people, a lower oil price.
Yeah.
What do you make of that statement? How would you frame
it's
that?
Really true. I mean, I think oil isn't a meaningful piece of everybody's expenses, and it flows through to other things. Depending on where you live, it can flow into the, if you have heating oil. I mean, I guess most people have gone to natural gas, but yeah, it is QE for the people. It's a great thing. I mean, don't get me wrong. I'm all in favor of lower oil prices. I'm all in favor of, additional drilling. And I think there's plenty of oil in the world, and I think at the right price it'll be found. I mean, it does get a little tricky if it falls too far in the United States. Some of the shale stuff we're doing, and fracking that we're doing becomes uneconomic. So I think what the oil people would tell you is we'd like it to, we don't care if it falls a bit. We don't want it to plunge because that can create a problem. So, but yeah, lower oil prices is a very good thing.
No. And I know I'm jumping around a little bit, and I apologize for that, but I want to come back to the capital rotation aspect and money potentially leaving the U.S. Do you see that money ever returning, and do you see the world being more fragmented, saying, let's say the EU says, no, you cannot invest in the EU, in the U.S., for example, or pension funds need to spend X amount or percent in local domestic stocks, I don't know, whatever projects.
Yeah, well,
how does that impact everything?
I think we're moving from a world where the dollar was king and the dollar was 95% of all oil transactions, and other currencies didn't matter. And I mean, this is going back a ways. The U.S. bonds were the safest place to put money, and they were the base layer of the financial system. We're moving from that world into a different world where there are lots of competing currencies. They all have their own strengths and weaknesses. People can transact without using the dollar. I mean, we see China and the Saudis, doing yuan for oil and so forth. And if the Saudis receive yuan and decide they don't have something the Chinese make, machine tool wise, that they want, they can just go over to the Shanghai Gold Exchange and buy, gold contracts. And I think they're doing that because the contract volume there has just exploded over the, past couple of years since we grabbed the Russian, reserves and sanctioned them. We're going to see a world that looks different. I mean, where the U.S. isn't the king anymore, we can't export our inflation. The dollar's not as strong. You'll see reshoring into the United States. I mean, honestly, in my view, one of the best things that could happen would be a really weak dollar. It would balance the world out. It would get America off of its debt binge. It would get us off our overspending binge. It would price things more appropriately and fairly. And having a multipolar world, in my opinion, would be a good thing. It would be fairer for everybody. And the ultimate way to get there is to return to a neutral reserve currency. But we're a little ways away from that. We got fiat currencies in all these countries right now. But I think what gold is saying, the relentless surge in the price of gold is saying, hey guys, look at me. I'm over here. I'm neutral. I'm a reserve currency. You can't print me. And if you want to save your money in something that's not going down, take a look at me. That's the message coming from gold.
No, absolutely. I think the message is loud and clear about what is happening in general. And if you haven't heard it yet and understood it yet, you must be living under a rock. But it seems like a lot of people are still living under a rock since you opened that can of worms. Let's go there. Because, the generalist investor is not there yet. Yeah, we're seeing a bit of ETF inflows, but bar and bullion demand is down. Coin demand is down. Yeah. It's roughly half from what it used to be. Like, where is retail? Like, is retail maybe blood dry? I'm trying to come up with an explanation.
They're over in the FANG stocks or the Mag 7 or the U.S. stock market because it was a one-way bet for so many years, and they're leaving there. I mean, we just saw that area fall pretty substantially, and so some of them that was a hit upside the head. Like, hey, what the hell's going on? I'm used to this thing going up 20% a year, and now I'm down. And then of course what'll happen is they'll start to look around. And, well, what is working? Well, gee, gold's working. Gold stocks are working. We have any of that? Nope. Well, maybe as a diversifier, I need some of that. Not like I'm going to go all the way into gold, but having zero of it doesn't really make sense if it's performing well, right? So that's kind of how it starts. And of course, by the end of this, we'll be at some crazy gold number, and the gold stocks will be insanely valued, and everyone will know gold is as obvious to us at that point in time as the FANG stocks were, in the last 10 years, or the Mag 7 was in the last 10 years. And, at that point in time, we'll be exiting to buy, low PE industrial businesses that pay a big dividend or something else, because, the change will have taken place. So, yeah, I think it's just a matter of, people get the memo slowly. I mean, and if you're a gold and silver bug and you've suffered through all the pain that we've suffered through, with brief exceptions. I mean, 2016 was a good year. 2019 and 20 were good years, but all the other years have more or less sucked. You're now starting to see it work again, and I'm sure there are those who say, it's too late or it'll never work. But on the contrary, I think we're quite early. I mean, it's just starting to work in a meaningful way, and I see gold at $5,000 or $10,000 an ounce in this cycle very easily, and I think that nobody believed that 2 or 3 years ago. I think a few people are starting to believe that now. I know you and I believed it for a while. So,
hard time putting a number on it, right? It's like looking at the chart, but now seeing the momentum going up, as you said, relentlessly to 3,300 today. And where did we start the beginning of the year? 2,300, 2,400 maybe. Yeah. So just in about 4 months, we're up $1,000. Yeah, 4, 5, 6, 7, 8, maybe $12,000 is possible, right? And
it's interesting. It highlights a point that I'd like to make for both for all your listeners and to you that I think is really important. The model here is not that this price necessarily reverts to the mean. The model here is that the monetary system is changing. So a lot of people look at something, a price run like that, and they say, well, that's overbought. That's a bubble. That's going to break. I don't want to buy it. I'm too late. And we see this in gold and we see it in Bitcoin. I see it particularly in the Bitcoin world. I have a lot of friends I've tried to convince on Bitcoin. They might get convinced and then they say, gee, Larry, that's great, but I got to pay 85 or 100,000. You were buying it at 5,000. And, I don't want to do that. I'm paying top price. And what I would suggest is that you turn this upside down and look at it as a slightly different thing. It's more like, the old monetary system was stable and the new monetary system is an avalanche. And we've had enough, snowflakes fall that the avalanche is broken free and it's got a ways to run. Or said another way, consider the old monetary system is the Titanic and it's being transitioned and changed to a sounder monetary system. And the lifeboat seats are represented by gold and silver and Bitcoin. And so, so I bought some gold at $1,000 an ounce and I bought some Bitcoin at $5,000 a coin, and those are seats in the lifeboat. The cost to you today, you want gold, it's 3,300. You want Bitcoin, it's 85,000. Same seat as the one I bought, but it's more expensive because we're a little further down the road. So, okay, Mr. Investor, do you want to continue and hang out on the Titanic, or do you want to pay more for the seat? Because if I'm right about the monetary system and it failing, we know that, if you had been on the Titanic and the same kind of thing had happened, it wouldn't have mattered what you had to pay for the seat. You wanted the goddamn seat because the alternative was terrible. So, it's being a little bit extreme, but perhaps not too much. I mean, this monetary system really is quite broken, and you need to read the book because the book talks about the history of these kinds of things. And, it may not go all the way to the Titanic sinking. I mean, we may just have really high inflation and a monetary reset, to be fair and to say that, but even in that case, gold and silver and Bitcoin will be an advantage to have over, all the other traditional assets.
We got to talk with the role of the US dollar, Ilk. We haven't really touched on it yet. The Dixie, as we said, it's below 100 right now. But what will the US dollar look like at that point? Like maybe in comparison to other currencies, like I brought up the euro earlier. Let's assume gold goes to 5,000. What does that look like now? Like what is the price levels and things?
Yeah, I mean, so the dollar is a funny thing because it's measured really in all the other fiat. I mean, all the currencies are fiat, right? There's nobody who's on a sound money standard right now. So you're measuring the euro fiat against the British fiat against the Chinese fiat against the American fiat. So I think the American fiat. If you look at the income statement and the balance sheet of most of those countries, I think the U.S. is just demonstrably in worse shape than all the others, but it's been the reserve currency, so it's enjoyed a premium. I think the dollar has a long way to fall, and I think all of those currencies. I mean, what they represent is they represent currencies, things you can buy things in. Everything's priced in dollars. You can easily do a dollar price of anything, as you can with a euro, and the FX markets are very efficient, so you can move from one currency to the other. So to me, how the dollar does against the other currencies, I think it'll fall because it's overvalued compared to the other currencies. But what really matters is not that cross. What matters is the cross between the dollar and gold or the dollar and Bitcoin. I mean, I think, look, Bitcoin does not have, and gold, there are mechanisms for doing it. I just heard about one actually in Britain that was pretty cool for kind of keeping, Bitcoin in your account, or gold in your account, and then paying for things in dollars or pounds. But because switching from one to another is not hard, but most people have, currency accounts based on their local currency, and they pay for things in their local currency. And I think what will happen is kind of a mass version of Gresham's law, which says that people will, yes, you'll continue, the dollar will be around, we'll keep paying for things in dollars, but that won't be, nobody in their right mind will ever leave anything in dollars for very long, because they'll know that they're melting, that they're losing value. And so to the degree you get paid or you have some savings, you'll instantly convert them into something that won't melt in value, and that's Gresham's law. The sound money, the bad money pushes out the good. People spend the money that's bad, the fiat currency, and they save in the money that's good, silver, gold, and Bitcoin. So, that to me is what's going to happen. But we're going to have a much more multipolar world, Kai, and I'm all for that. I mean, I think the U.S. has abused its privilege as the world's reserve currency. It's allowed us to conduct wars, do a lot of stuff that made no sense. So, having a more balanced regime of lots of currencies, and then with gold and perhaps Bitcoin as being the neutral reserve currencies, that'll be a better world, in my opinion. Yeah.
We got to talk Bitcoin real quick, and everybody knows I'm no expert on it, but I do have a couple questions.
Sure.
Maybe we'll start off with Bitcoin being a reserve asset, and you mentioned it. Is Bitcoin already a tier 1 asset? And I'm just looking at the Bitcoin price chart, and if I look at the gold chart versus the Bitcoin chart, the answer is no. But here's what your thoughts are.
Well, it depends on how you define tier 1 asset. I mean, personally, I actually happen to think it is, but I'm not sure the market agrees with me yet, to be fair, because it's traded as a risk-on asset. I mean, it's interesting. I think it can become and will become a tier 1 asset, okay, for sure, if you don't believe it is now, although I do. It is much more volatile than gold. Its performance has crushed the performance of gold, but that's really, they both benefit because, I mean, why does money have value? Money has value when it's scarce. I mean, sand doesn't have value. Oxygen doesn't have value. Water doesn't have value. I mean, except in specific circumstances, because it's not scarce. And gold is probably the scarcest element on the planet. And Bitcoin is a digital, copy of that. Bitcoin's a digital form of gold because there are 21 million of them enforced by a digital algorithm. And so, because they are scarce, if there's a certain amount of demand for them, the price is going to move, based on more demand and fixed supply. Bitcoin has been more volatile than gold because it's being adopted, and that's why it's performed better than gold. And because gold's been around for 5,000 years, everyone who wants it, knows about it, already owns it. Bitcoin's going through, a technology adoption curve very similar to the way there was a time when nobody had a cell phone, and now everyone has a cell phone. And I think that's how it's going to be with Bitcoin. I mean, right now, less than 10% of the world has or knows about or really owns any Bitcoin. But I think at some point, most everyone will own Bitcoin. And the reason I say that is because it's a unique invention that has properties which make it in some ways as good as or better than gold. And that is to say, it's more easy to transfer and verify. And so, it's not the neutral reserve asset, but it could be at some point in the future. And I thought it was very interesting. Larry Fink, who's a big U.S. Runs the largest U.S. asset management firm, BlackRock. He came out and he actually in his most recent annual report said, it's a competitor for the potential neutral reserve currency of the future. And I thought, wow, that's interesting. Here's a guy who's very deeply entrenched in the fiat world, and he kind of gets it. So, and I think what I would say to gold bugs who are hearing this and are skeptical of Bitcoin is buy my book and read it, because I was a gold bug and I was skeptical of Bitcoin. And it's not a no-brainer, and it's very volatile, and it's not for everybody. But it's not nearly as bad as the crypto people and the Sam Bankman-Frieds of the world would lead you to believe. I mean, I think one mistake a lot of gold people have made is they've associated with Bitcoin with all other crypto. All other crypto is complete crap. I mean, we call them shit coins, and there's incredible bad behavior, fraud, malfeasance, everything. The whole shitcoin world is terrible, and it's really damaged Bitcoin. Because throughout and they're all Bitcoin's a cryptocurrency, so are all the shitcoins. The difference is Bitcoin is a cryptocurrency that represents a technological innovation that took 30 years to solve, and they did it through a lot of iterations. If you look at all the people who we think are Satoshi, they slowly but surely put the pieces in place, and then they finally figured it out. And now we've got something that for 16 years has been immutable, has not been cracked, has not been hacked. And so, the level of confidence in it is growing. And so I would suggest to gold people, I try to convince my clients, I say, look, I'm not suggesting you have to go all Bitcoin. That would be crazy. But I am suggesting that to have zero Bitcoin, given its optionality and its asymmetry, that's not necessarily wise either. You can handle the volatility if your weighting is small. If you have a 3% weighting and it goes down 50%, so you lose 1.5% of your net worth, well, you're not going to die. You know what I mean? And in turn, that 3% weighting might go up 10x. I think it will. And that gives you a 30% return on your whole portfolio. So that's what, asymmetry is what you're looking for. And again, the book talks about that.
Yeah, maybe just as a follow up to that, like Bitcoin made a massive price move to the upside here once the crypto reserve was announced, or the idea of a crypto reserve. Where do we stand on that topic? I haven't heard much lately. That's why I'm asking.
Yeah, it's a great question. Well, so they, look, a couple of things have really benefited Bitcoin last year or two. So the Democrats were very, very negative on Bitcoin. Elizabeth Warren's anti-crypto army. Two things that, and I used to deal with a lot of my peers in the investment management business, and they say, yeah, Larry, it's all great, except the government's going to come in and shut this thing down, right? I mean, this is too good to be true. They're not going to let you do it. Well, in January of 24, the ETF got approved. All right, well, that's not the government shutting it down. And then, of course, Trump got elected, and he embraced it, because a lot of Bitcoiners supported him and were helpful in winning the election. So, and then he said, we're going to hold on to what we've got, and we're going to set up a strategic Bitcoin reserve. And then Senator Cynthia Lummis from Wyoming has proposed that they actually purchase Bitcoin and add to that reserve. I mean, we've got the reserve contains 200,000+ coins that they confiscated through law enforcement activity back when it was Silk Road and doing all kinds of illegal stuff. And so, yeah, I mean, I think what you're seeing is at least the red team of America realizes that digital assets are important, and that leading in digital assets is important, and that the United States should be aggressive about leading in digital assets. And there's a guy named Jason Lowry, he's a major in the Air Force, he's now in the Pentagon, who wrote a book about this and basically said, it's going to be important as a sovereign nation that you have a strategic reserve, just as the U.S. has a strategic gold reserve, or I should say theoretically has a strategic gold reserve. We don't know if it's really there. The country, any large country should have a strategic Bitcoin reserve. And I believe that to be true. And so, whether the Lummis bill passes or whether they're actually able to start buying Bitcoin, it's unclear. Excuse me. Excuse me. But I think that just the fact that we have a reserve and have announced that we view it as an important thing is a positive. And honestly, I think that if you think about it from a game theory point of view, I mean, it's very clear to me that China has made a bet on gold. Those of us in the gold world know that they claim reserves of 3,000 tons or slightly less, I think. But in fact, we've looked at the shipments from Switzerland and other places into China, plus what they mine locally, and we know that they hold much, much more than that. And they have a huge affinity in their culture for gold. And so to the degree that we see all the fiat currencies failing, I think there's a chance that China would make the bet, okay, well, let's solve that by going back to the gold standard. One way for America to perhaps leapfrog China and say, well, yeah, that's great. You guys go to the gold standard, but that's old stuff. We're going to put our currency on a Bitcoin standard. And which I know sounds crazy and outrageous right now, but I don't think it's as crazy as it sounds. And we would effectively leapfrog them because Bitcoin, the dilution in Bitcoin is actually lower than the dilution in gold and will continue to get lower over time.
Now, really interesting insights. And I have one last question on the whole topic.
Yeah.
You said the U.S. cannot print gold, silver, or Bitcoin to a degree. There's one angle, like I really just for the last minute here, I want to explore it, and that's quantum computing, but it could potentially hack Bitcoin or crypto. So while as far as I know, there's been no advancements in terms of alchemy. So, but in quantum computing, though. So I'm curious what your thoughts are on that. Maybe as a last question.
It's a very good question. It's a legitimate risk. And those of us who are in the Bitcoin world have been studying it, and reading about it, and listening to the people working on it. And a couple things pop out. I mean, one, most intelligent people that have looked at it, realize that if it's a threat, it's many years away, like more than 5, more than 10, probably more than 15. But But at some point, look, with AI and all the other things, at some point we're going in that direction, and so it could theoretically become hackable. I would say that what those of us who are in the space and the smartest engineers in the space say, is that Bitcoin is maintained, the core software is maintained by a group of core developers, and they propose changes to the core, and then everybody votes on it. And of course, everybody votes for what will protect the system because they have their money in it. And so, what these developers tell me is that to the degree that quantum makes progress, that same progress can be implemented into the Bitcoin algorithm. In other words, they'll make a move quantum will make a move to make it hackable, and Bitcoin will make a counter move to make it unhackable. And so, or potentially there'll be a hard fork to the new unhackable Bitcoin by quantum. So I don't know. I mean, look, I think that's certainly an area that bears watching. And I think it's certainly a risk. I don't put it as a top risk in the next 5 to 10 years. And so, I think we all just watch it. I mean, the other one is kind of the MySpace, Facebook argument that somebody will come along and invent a better Bitcoin. And I don't think that's likely because, one, Bitcoin's pretty damn good the way it is. But two, to the degree that it did occur, I think you'd have time to move because people would see the new invention and there would be movement from Bitcoin into the new thing and so on and so forth. But it's kind of like Google. I mean, Bitcoin's got hundreds of millions of users all over the world, and it's got an enormous network effect and billions of dollars spent on the computers that verify the ledger. And it's just, I mean, imagine somebody coming along today and saying, "I've got a better Google. Use this." I mean, it's like, really? I mean, it just, it's got to be a whole lot better.
Well, ChatGPT is starting to give Google a run for its money.
That's a fair point. That's actually a fair point. I mean, ChatGPT has got some nice search features, no question, and good information on it. So it's not entirely impossible. And so I keep an eye on all these things, but I feel pretty good about where it is right now.
No, fair enough. No, really appreciate you bringing my questions here on Bitcoin. It almost sounds naive, so I appreciate it.
Being skeptical is a good thing. I mean, there's nothing in investing that's certain, as we both know.
I'm German. I'm always skeptical, right? So I do apologize for that. No, Larry, what a wonderful conversation as always. Can't believe it, 45 minutes. Lately, conversations just fly by. I'm having too much fun doing these interviews. So
yeah, it's good. Well, it helps when you're in a bull market for your stuff. Life is better, right?
Oh, absolutely, and the sun is shining outside. It's a good time to be alive.
We've had these conversations in years past when it's just like, oh, what the hell?
What are we doing here? We sat down in New Orleans together. It's like, why?
What are we doing owning this shit, right? It's painful.
Exactly. No, it's good. There's a lot of green. There's one red position now, and I'm not sure why. It's a smaller one. So, but it's all green on at least on my portfolio today, which doesn't happen too often. So I'm in a good mood. Larry, where can we send our audience? Where can they find your book?
Yeah, the book is on Amazon. It's in 4 formats. It's hardcover, paperback, ebook, Kindle ebook, and EPUB, and also an audio version, which is 12 plus hours. But if you listen to it at 2x, like one of my good friends does, you can do it in 6. I don't know how anybody can listen to anything in 2 hours or 2x speed. But and then I'm on Twitter a lot under Lawrence Lepard, at Lawrence Lepard. And then I manage a couple of funds. One is called the Equity Management Associates Fund, which is gold and silver miners. And the other is the Bitcoin Opportunity Fund, which is raising money right now, which does all kinds of Bitcoin things, did extremely well last year. And if you're a qualified investor, which means you got more than $200,000 to invest, you can participate in either of those funds. Just Google me and reach out. But more importantly, I think the message to your viewers is just, make sure you have enough sound money assets, in my opinion, because we are in an inflationary world that's going to continue for multiple years and perhaps could really get out of control. And so you want to be protected from that possibility of it getting out of control. Even if it doesn't get out of control, it's going to work, but it could work like, crazy, silly kind of stuff. So you want to have some investments in this area.
No, you appreciate you bringing that up. I forgot to ask my summary question, like parting advice here, but you shared that, so I appreciate that tremendously, Larry. By the way, who read the audiobook? Was it you?
No, I couldn't do it. I didn't have time. I got so much going on. There's a guy in America. He keeps his name private. He's called Walker America. So if you Google Walker America on Twitter, you'll find him. He's got a fabulous voice. Did a fantastic job doing it. And no, I just couldn't do it. I mean, I'm trying to manage these funds and everything else. He's got a better voice than I do anyway.
You couldn't get Morgan Freeman?
No. Yeah. Or Alfred Brimley. Yeah, no.
Yeah.
Yeah,
Yeah, it's too bad James L. Jones isn't available anymore.
yeah, yeah.
So.
He would have been good too. Yeah, he's passed, but yeah, Walker did a great job. So, and I know it's surprising. What's interesting, Kai. I guess a lot of people, they don't like to read. They listen in the car or the truck or whatever, and so the sales on the audiobook are really fantastic. It's kind of crazy.
No, it's true. It's an easy way to consume content while you're out for a walk or so. Try walking with a book. There are too many trees where I live, so it's kind of dangerous.
Exactly.
Awesome. Larry, thank you so much for your time. It's great to have you back on.
I really enjoyed it, and I hope to see you soon at one of these conferences.
Same. I'm looking forward to it, and everybody else. Thank you so much for tuning in. I hope you enjoyed the conversation with Lawrence Lepard. If you did, go check out his book on Amazon, and of course, leave a like, leave a comment down below, and if you haven't done so, hit that subscribe button. It's a free way to support us, and we tremendously appreciate it. Constructive criticism is always welcome. Put it down below. We'd love to hear from you. Thank you so much for tuning in. Stay safe out there. Take care.